goal to help you out with your year-end planning, and ultimately to minimize taxes, which is one of our goals all the time. Whenever you save a tax dollar, it's actually, goes right in your pocket. So, legal disclaimer, we welcome you to use this. We're going to have the recording posted on our website and share it as many times as you want. If you want more information, just let us know. So one of the things that we try to do with our business clients is we want to help them grow cash flow and company value while creating an extraordinary owner and team experience. And so this is part of that, to keep you all informed on what's going on with this big, beautiful bill. And as you'll see, there's some really awesome items in here. Specifically, we're going to focus in these 7 areas and give you an idea of what the main value of these items are to you as in your personal income tax. So with that, this is probably the biggest one, and it has to do with the extension of the new rates under the 2017 Act. And you can see the effects. So under the old rates, they dropped after the 10% rate from 15 to 12 on down to 36 to 37. I ran some numbers to just kind of give you an idea of what that impact means. And at 40,000 of income, without the TCJA, your taxes would have increased $700. So, or 41% of your total tax bill. In other words, if this big, beautiful bill didn't pass in July at the 40% income level, your taxes would have gone up 41%. Now, if you're fortunate enough to be at $1 million, yours would have increased 9%. So I think this calculation gives you an idea that, hey, we're all better off just based on the rates alone that this passed. So that is some very good news. And maybe you feel a little better about buying some Christmas presents that maybe you wouldn't have otherwise. So next, and those rates were permanent. Now, there were some changes back in 2017 to the standard deduction that got doubled. So, in other words, for single filers, that went from $6,350 to $12,000, and for married filing joints from $12,700 to $24,000. Personal exemptions were eliminated, but that increase to the standard deduction kind of more than offset that for most families. So more good news. There were some caps on real estate taxes, as many of you know. But again, the raise in the standard deduction more than offset that. So these were all extended back in July. So that is good as well. Speaking of families, the child tax credits, the amount doubled from 1,000 to 2,000, and then for the period 2025 to 2028, there is a boost to 2,200. So more good news. And then There's also a credit of $500 for non-child dependents. So if you have an elderly parent, there's a credit available to the tune of $500 there as well. Okay. So many changes, many benefits to depreciation, and this just makes it easier for businesses to invest in equipment. And one of the biggest ones is restoring the 100% bonus depreciation going back to January 19th, 2025. So some businesses maybe that bought equipment back in, say, May, were thinking that they were only going to get bonus depreciation of 40%. However, with the big beautiful bill, that restores it to 100%. So a nice surprise for them. And then Section 179 is expanded as well, and raises the cap to $2.5 million of eligibility for expensing, and starts to phase out at $4 million. Manufacturing facilities. So this is really, in some respects, extraordinary from the standpoint that you can expense 100% of your manufacturing facility. So if this is relevant for you, let us know and we can help you get more of the fine details on it. But overall, it makes it a lot easier for businesses to invest. Okay. So back in 2017, the C Corp tax rate was 35%, and it got cut to 21%. So one of the ways to compensate S Corp owners and pass-through entities was to create this qualified business income deduction of 20%. There are some limitations on it. Like, for example, there's a phase out for single filers at income levels of 191,950 and joint 383,900. But that's after your standard deduction. It's just taxable income. So sometimes people don't think they qualify, but then when you crunch the numbers, after taking into account things like the standard deduction, you end up being eligible for this 20% qualified business income deduction. And it's extraordinary when you think of the idea that you're actually getting a deduction that you don't have to spend dollars for. So if your profit is on a K1, say 100,000, you're getting a $20,000 deduction out of the air to help you with your taxes. So that was extended in July under the big beautiful bill. So qualified opportunity zones, this may not be on your radar, but essentially, if you invest in a qualified opportunity zone for more than 10 years, you can exclude the entire gain. So it's essentially the holy grail of tax planning, because you buy low, sell high, and pay no tax. So if this is relevant, we'd love to help you explore this more. Okay, so this got a lot of press, the SALT deductions, especially for states like ours, where we have high real estate taxes. So fortunately, the real estate cap, or the SALT deduction was raised to 40,000 for 2025 through 2029. Um, and there is a phase out, but that doesn't come into play until your income is in excess of 500,000. Okay. So the estate tax exemption was extended, which is big for some because it was going to go from 14 million of excluded assets to 7 million. So that would have been a massive tax increase to estates that this was relevant for. And so that is good. And that was made permanent. So there were $7,500 credits for electric vehicles up through September 30, 2025. And so after that date, so 10/1/2025, that credit was eliminated. And so keep that on your radar. I know, a lot of clients were interested in that. And then same thing for the solar credit that terminates after 12/31/2025. So this gets this is pretty interesting. These are some of the extra items that are very unique to the Big Beautiful Bill. So 25,000 up to 25,000 of tip income is exempt from income tax, but not payroll tax. And that is for the years 2025 to 2028. There is a phase out after, as a single filer, your income exceeds 150,000, and 300,000 after your income exceeds 300,000. Also kind of neat is the idea of overtime pay being not subject to tax. So there are some nuances on this that I'd like to spend a minute to talk about. So with overtime pay, it's just the premium portion. So if you're getting paid, say 15, if you're getting paid, say $20, and then for overtime hours, you're getting paid time and a half. For those overtime hours, you're getting paid $30 in the example where your normal pay is $20. Only the $10 is exempt from tax. So there has been a lot of confusion that employers are not required to report that to their employees. All that is meant is they're not going to get penalized if they don't report it. But if this is relevant for your business, you want to make sure that your employees have that premium number, that $10 on the relevant pay, so that they can exclude that for their taxes. Now, you can do that a couple ways. You can include that information in box 14 on their W-2s. So if you use a payroll service, you'd want to talk to them about identifying that separately. If you don't have that ability, you can also include a statement so that they know what the number is for their taxes. And the deadline for that is January 31st, 2026. So there was talk about Social Security not being taxable, but that didn't change. However, there is a new standard deduction, an extra kicker for seniors 65 and older. For singles, it's 6,000 and 12,000 for married filing joint filers. So that's helpful. And then there's also the ability to deduct up to 10,000 of interest on car loans. And that is an above the line deduction, so you don't need to itemize in order to get that benefit. However, it does phase out at 100,000 for single filers and 200,000 for joint filers. With a lot of these, there's some complexity to it when you consider the phase outs. And so if you want our help, we can run a detailed estimate and help you figure out whether it works for you or not. Okay. So these are some additionally new items that are out there. So you may or may not have heard of this. It's qualified small business stock, which allows you to exclude up to 10 million in gain, or 10x the times of your basis, whichever's higher. So in other words, you're not paying tax on that. So that was extended. That doesn't affect too many people. This next one may. Gambling losses are limited to 90%. So this could be a big deal. Just to give you an example, let's say that you won 100,000 in the slots, went over and lost the 100,000 at the tables. What this means is, under the old rules, you'd be able to, your taxable gambling win would be 0. Under the new rules, you would have to pay tax on $10,000. So even though you netted 0, you'd still owe tax on $10,000. So if this is relevant for you, make sure that you keep that in mind. So what I'd like to see you do is stop after the 100,000 and then just pay tax on that gambling winning. So next, Alaska fishermen. There's some additional breaks in deductibility where let's see, you're able to expense instead of 10,000 up to 50,000. Next, under 529 accounts, those are eligible, or were eligible, for owners of those accounts to spend up to 10,000 on K through 12. That was expanded to 20,000, which is great. And then additionally, in the big beautiful bill, what was introduced, and we talked about this back in August, but there's new Trump accounts. So if you had a child born in 2025, you're able to essentially get $1,000 from the government that gets invested into a low fee index fund. And those funds grow tax deferred until age 18, when they can use it for a qualified distribution, which includes education, home purchase, or medical. And then there's some other limitations as far as withdrawals, but if they're qualified withdrawals, you're able to only pay long-term capital gains. If the withdrawals aren't qualified, then you're paying ordinary income tax on those gains. So a very nice deal, and family can contribute an extra $5,000 per year into these accounts. So they're very versatile. And then after, I think it's age 30, those funds are available, and there is no restriction on what they can be used for the owner. But essentially, the government's contributing $1,000 to this account to get it going, which is awesome. There's been some calculations where it's easy for these accounts to grow to be $1 million. So they could be a really significant asset for children born in 2025. Next, there's some additional wild card type items that just something to keep in mind. This is with a lot of these, I think you saw these were permanent, but I really liked a Mark Twain quote, and I think it's something we should consider with all of these permanent deductions, in that no man's life, liberty, or property is safe while legislature is in session. These tax breaks that were extended with the big beautiful bill are here now. Enjoy them. Enjoy the tax savings. The big beautiful bill is in many respects done the work, but we're hosting this webinar to make you aware of it. We'd love to work with you on any of these that are relevant to you. So we're gonna have some time for questions. We covered a lot, so I want to give a few minutes for questions, and then I'm going to spend a little time to take you through setting up an account with the IRS. So that'll be a little bit of a bonus on this webinar, because it's very difficult to get a hold of the IRS these days. So when you set up an online account with them, you have access to a lot of different things, as you'll see in a minute. So with that, you can chat them or unmute. And
Tim, I have a question.
yes.
A lot of times comes out like personal cars through a business when it's deemed part of the business, but there is personal use of the vehicle. Would that apply to 179 deductions, and would that be eligible for some of the deductions from that standpoint? And then might you be able to briefly walk through like personal considerations when buying a car through a business and there is some level of personal use?
Sure. So if the car is used more than 50% for business, the personal use portion, which is valued based on IRS tables that are published every year, that gets added to the W-2, just like a non-cash benefit. That car then would be eligible for Section 179. Now, a big issue happens if that business use drops below 50%, because then there needs to be a recapture of that benefit from the Section 179. Does that answer the question?
That does. It
Okay.
just, at times the use of a car through a business comes up, and I just felt like it might be useful to others on the call as well. So
Oh, yeah, no, absolutely. Absolutely. So we got one texted in. I recall from a previous webinar that charitable donations are changing. And so, yes, that is correct. There is an above the line charitable deduction that was increased. Essentially, they were doubled. And by being above the line, that means that you don't need to itemize in order to get your charitable deduction. So, great question. All right. Any last ones? I'm going to use the last couple minutes to dig into this IRS account because I think it could really help a lot of people. All right. So I'm going to reshare. Okay. So this is my pro tip to you. Set up an IRS account. In order to do that, you would first off, you can go to this IRS site, and when you have an account with the IRS, it allows you to conveniently access all of your IRS transcripts. You can look at notices, look at your payment history, see your prior year adjusted gross income, view other tax records, information return documents. So you can pull anything that's been reported for the last 5 years. Essentially, this is what you'll see. When you log on to your IRS account, you'll have all these account transcripts, which are very handy. If you're looking to approve income, say for a bank, this is what they're pulling on you. So it's really a great resource. You know, there's a number of instances that I can think of where clients have sent money into the IRS and they're not sure if the IRS got it. This takes all of the question marks out of the picture because you just go onto the IRS site and you're looking at exactly what an IRS agent is looking at. And right now, if you try to call, the last 2 times I called the IRS, I waited on hold for over an hour. When someone picked up, they hung up immediately. So there's nothing, no one's got an extra hour to throw away. So get an IRS account. Now, in order to access the IRS site, that you need to set up an IRS ID.me account, and this secures your access. So it's a good thing. It's a little bit of a pain in the butt, but it's really a good thing. Now, if you go to this site and you don't have an ID.me account, you'll have the ability to create one. And when you do that, you know, to be ready, you should have a government issued photo ID that's not expired, camera enabled smartphone or computer with webcam. Make sure you have a reliable internet connection to avoid interruptions during the process. Follow all the on-screen instructions carefully and double check the information you enter for accuracy. And then if the self-service automated process fails, promptly switch to live video chat option with ID.me agent for assistance and prepare all the necessary documents in advance to avoid delays. So it's a process that we've gone through ourselves individually and with some clients. If you're really struggling and you want to come into our office, we can sit down with you and help you through the process if you have all this information. But anyhow, it is really valuable to have this available to you. So that's my pro tip. That's the webinar. Thanks for joining me. And everyone have a Merry Christmas and a Happy New Year.